Kellogg is a very well-known company, a very well-known brand. You probably know Kellogg's through its cornflakes. Ever since wW.K.Kellogg created cornflakes, which have redefined breakfast across the globe, things have changed for the company. Nowadays, Kellogg's owns more than just cereal, and now it's looking for a way to separate itself from its founder's legacy. Kellogg's is splitting into three companies: a snack company, a second company focused completely on cereal, and a third company centered around its new plant-based foods. We will call these three companies the Global Snacking Company, North American Cereal Company, and Plant Company, after the names given in Kellogg's statement on its website, because the new names of the three companies have not been finalized yet. According to Kellogg's, its core snacking business will remain with the company, while it spins off its cereal and plant-based food brands. The core snack company, Global Snacking Co., will contain Kellogg's most popular brands, which will include its Pringles chips, Pop-Tarts, and international cereal and noodle brands. Kellogg's has stated that international brands will remain with the Kellogg's company, while more popular North American cereal brands will be split off into new companies. So as an example, Kellogg's cornflakes sold in the UK will continue to remain with the Kellogg's company because it is operating internationally, but Kellogg's cornflakes sold in North America, Canada, and the Caribbean will be spun off into the new cereal company. This does not mean that the Kellogg's logo, name, or brand will be changed after the spin-off. So rest assured that those frosty flakes with Tony the Tiger on them on American shelves will still contain the Kellogg's logo on the box. Kellogg's core company will simply license the Kellogg's brand to the new cereal company. The reason the company is splitting its local and international cereal brands is because cereal sales in local North America is around $2.4 billion in net sales, large enough to warrant setting up a new company, while international cereal sales don't have the scale necessary to survive on its own. So in summary, Kellogg's will split into three different companies. Global Snacking Co., which had an estimated net sales of $11 billion, will house Kellogg's global snacking business, its international cereal brands, frozen breakfast brands, and noodles, the total sales of which account for 80% of the original Kellogg's company turnover. Its core business will include name brands like Pringles, Cheez-Its, Nutri-Grain, Pop-Tarts, and RX Bar, making up 60% of its sales. Less than a quarter of net sales will come from the cereals sold in international markets like Frosties, Special K, Crave, Cocoa Pops, Crunchy Nut, and more, while 10% of net sales will come from Kellogg's rapidly expanding noodles business in Africa. The remainder of sales will come from its frozen breakfast segment, which include, for example, the Eggo waffle brand. Products which account for the remaining 20% of Kellogg's net sales, like cereal and plant-based foods, will be spun off into different companies. The new cereal company, North American Cereal Co., has an estimated net sales of $2 billion based on 2021 numbers and will include popular American brands like Fruit Loops, Special K, Rice Krispies Treats, Mini Wheats, Raisin Bran, Cornflakes, Kashi, Bare Naked, and Frosted Flakes. On the other hand, Plant Co., Kellogg's plant-based companies, will include its popular Morningstar Farm brands, which sells products like veggie burgers that generate $340 million in net sales in 2021. Kellogg's business have been doing well for a while now, so why are they choosing to split up the company? Kellogg's CEO, Mr. Kellogg, revealed the reason when he told reporters that Kellogg's share prices have not moved significantly over the past decade and requires something special to get it moving again. And he believes that Kellogg's stock split could be the new impetus. In the past 10 years, Kellogg's stock price went from $55 to $70. That's a low 30% rise in the last decade. In the past 5 years, Kellogg's stock price have only risen by 8% overall. So Mr. Kellogg is right to attempt this Kellogg split to unlock shareholder value. If anyone is wondering what will happen after the stock split for investors, this is how it goes. Investors holding Kellogg stock will be given shares of the two new spin-off companies. So if you hold Kellogg shares until they complete their spin-off by the end of the year in 2023, then in addition to the Kellogg shares you will get to keep, you will also get shares of its new cereal company and shares in a company which sells plant-based food. For Kellogg's split will be done to focus on high-growth sectors like plant-based foods and breakfast food sectors. Kellogg's needs to split itself into three so its core business can focus solely on the global snacking snacking industry. This will also allow it to be more nimble and compete with other competitors like PepsiCo's, which sells Frito-Lay chips, and Mondelez, which owns the ever-popular Oreo. With the split, Kellogg's will be free to introduce more snacks and expand its product lineup by snapping up better brands, similar to how Mondelez acquired the Cliff Bar company for $3 billion recently. A Mintel report suggests that Americans are eating snacks multiple times a day and reported the new behavior will only continue to increase in the coming years. Those surveyed aged 35 to 54 replied that snacking throughout the day was much healthier than eating 3 meals a day, while 2/3 of the sample size said they were willing to pay more money for healthier snacks. The reason why Kellogg split off its North American, Canadian, and Caribbean cereal divisions into its own separate entity is because it doesn't want to be bogged down by the stagnant US cereal market. Less people are eating cereal for breakfast, so the cereals that have fueled Kellogg's growth for decades and was the main thing it was known for have been relegated to the wayside since cereals are no longer the key growth drivers for Kellogg's. Kellogg anticipates that its cereal division will have flat revenue growth in the future. This ties into why Kellogg's chose to focus on the snacking industry. However, since revenues from its cereal division will still be stable, the company expects to keep it as part of its portfolio instead of selling it. Kellogg's plant-based business, on the other hand, would benefit from the split as it would become a true threat to Beyond Meat. Its $340 million in sales and position as the highest household penetration in the frozen vegan category is a clear improvement from the Beyond Meat company, which has never made any profit in the last 3 years. The value proposition of the new company, anchored by Morningstar Farms, is significant enough to give new investors pause. It might also goad them into piling their money into the new plant-based food company instead of other unprofitable rivals like Beyond Meat. Despite this, Kellogg's is open to selling its plant company, to any willing buyers as long as they are happy to pay a premium for it. Some might argue that Kellogg's could have just as easily managed its business without splitting them up. That is not true. Having multiple brands and product types under one roof means each individual product division will have to compete with resources and money within the company. Frosty Flakes would have had to compete with Pringles for management's time and funding, while Morningstar Plant-Based Foods would have had to compete with Pop-Tarts for company resources. Separating all similar products into different companies simplifies the business so each company will know how to utilize their resources. There will be no more situations where the high-growth snacking business competes with the slow-growing cereals business, which Kellogg's is uninterested in spending too much resources on. With more efficient ways of allocating resources as independent companies, Kellogg's good ideas won't slip through the cracks and the risk of managing too many products at once won't appear. Pumping out new products into their own unique markets will also be a lot easier under companies which have their own specific focus. Kellogg's CEO himself has said that he believes both North American Co. and Plant Co. have been held back from their full potential because each division had to compete for capital against the more profitable and faster growing snacks business. The move to spin them off into two standalone entities would allow them to benefit from the cost savings and be more aggressive with pursuing new product lines. Another reason why Kellogg's wants to split is related to its thirst for more investor money. Kellogg's gets a lot of money from the sale of its stock market shares, just like any other company on the stock market. However, Kellogg's ability to gather money is hampered and impeded by the fact that it is a giant conglomerate. Investors usually value companies like Kellogg's less because of how many businesses and markets they are in. This phenomenon is called the conglomerate's discount, where the valuation of the company is often lower than the sum of its parts, especially if each of the product's businesses are operating separately from one another. This is certainly the case for Kellogg's since its cereal division operates separately from its snacking division under a single company roof. A large conglomerate can usually shed its conglomerate's discount by splitting its business so each company focuses on specific parts of the market. With this, investors will find it easier to invest their money since there will be a lot of investors before this who are reluctant to invest in Kellogg's legacy cereal division because it has slow growth. Slow growth usually implies that the stock prices will remain flat, so investors don't want it. With the split, investors can invest in Kellogg's attractive high-growth snacking division through the new company after the split is done. High growth means the stock price has a chance of going up faster, so investors will buy more Kellogg stock because of this fact. Kellogg stock has always been cheap and relatively undervalued. It trades at 16 times its 12-month forward earnings, which is lower than its peers. Mondelez, Colgate-Palmolive, Coca-Cola, PepsiCo, and Post Holdings all trade at over 20 times earnings. Hopefully, the Kellogg split will buck the trend and unlock Kellogg's value in the market. Kellogg split follows giants like Johnson & Johnson and General Electric, which have announced their split last year to break out of their sluggish growth. The split will shed the conglomerate's discount and unlock shareholder value. Kellogg's split mirrors the response by other companies, which have been trying to acquire more loyal consumers by selling off brands that are no longer profitable enough to fit a growth strategy. Kraft has sold its Planters peanuts and Cracker Barrel cheese products, while Unilever sold its Lipton tea and Brooke Bond tea brands to CVC Capital Partners for $4 billion in 2021. Kellogg's current CEO will continue to head the Kellogg's Company core businesses, Global Snacking Co., while management for the other two companies are still up in the air and have not been finalized yet. Overall, the split is expected to unlock the full potential of Kellogg's businesses and generate more growth for the company at a time when consumer habits are shifting as Gen Z takes over the economy. Kellogg's split is still a bet made by the company executives, so it remains to be seen whether their step down in profits would offset the step up that they are expecting to get from their valuation. With inflation running rampant and a recession looming on the horizon, the market is having a ton of trouble valuing growth companies, so Kellogg's proposition to unlock shareholder value might fall on deaf ears. Otherwise, others who don't like Kellogg's split are arguing that companies usually split because their businesses don't work well with each other, while Kellogg's three new companies, the Global Snacking Co., North American Cereal Co. and Plant Co. are not all too different from one another, with all of them belonging to the food category. Some have questioned whether the split into smaller, more agile companies might make these new smaller companies vulnerable to headwinds, which would have been shielded by a bulkier Kellogg's conglomerate. A few believe that Kellogg's restructuring to highlight its revenue growth in the snacking industry comes at a bad time, especially when growth stocks are underperforming. So investors might be buying shares based on fat cash flows that Kellogg's currently has instead of revenue growth. JP Morgan analysts are saying that the split could damage Kellogg's profit margins and that Kellogg's planned snack company could lose money after it loses shared services and the scale that Kellogg's current business has to offer. Kellogg's split follows the portfolio shaping trend, which involves shedding and buying out businesses. Soon, a lot of other companies in the food business will follow Kellogg's organizational shift, so expect to see a lot more company splits from big names like Kraft Heinz, General Mills, Hershey's, and Mondelez in the near future. Unilever could also try to split off its Ben & Jerry's ice cream brand away from its many other non-food related products like Dove, while Constellation Brands might try shifting away its Campbell's snack unit from its beer business. Like and subscribe.